Good Friday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, please take a look at the shared disclaimer. Be aware that neither Market Chameleon, Dimitri Mira himself, are registered investment advisors or a broker dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows, are about Market Chameleon tools and products and for informational purposes only. With that, D, you ready to roll today?
Yep. Good morning, everyone. And I'm going to share my screen here.
And we're talking about upcoming earnings options backtest screener this morning, correct?
Yeah. So what we'll do today is cover a tool that is focused around earnings events. Right now we're in earnings seasons. We looked at a report yesterday that helped us answer some questions around earnings. So this is a different tool that looks at how to answer certain questions around earnings from a historical perspective. And the idea here is that when we look at option strategies, there are different types of strategies that you can structure around earnings depending on your viewpoint, or just trying to some people just stick to a certain strategy. And for example, you could do a directional uh, strategy for bullish or bearish, but you could do a non-directional, like a straddle, where that focuses on, well, did the stock, if you're buying the straddle, did the stock move enough to make that straddle profitable? Or if not, how much value did the straddle lose the next day if the move was much less than anticipated? And
Hey,
one
D,
of, yeah,
before you get too deep in this, I know we're going to get this question. Can you navigate to the screen if someone lands on the page for the first time? We have a couple
yeah.
new.
So under earnings menu, if you go to the right, you'll see here earnings option strategies right here. Okay. And that's where we're on right now, Market Chameleon. And when we look at history, we may ask ourselves, well, what how did a strategy of just being long a call perform? Because yes, the stock's not going to go up every time. Sometimes it will stay the same. Sometimes it will go down. So, or it'll go up a little bit. So the call will lose value. There are other times that it may go up um, by an extraordinary amount that given that scenario, on average, being long a call, and at the money call and out of the money call, may be a good performing strategy, even though you're going to incur even potentially more frequent losses, but the wins offset the gains. So those are the ideas there. But how do you test that? Right? It's very difficult to go and say, well, I have the strategy in mind, and I wonder how it performed. How did the markets price things um, around this event? Where how did those strategies perform if we looked at it, from one reference point to the other? And we could look at it at different reference points. We could look at it the day before earnings and see how it performed the next day after reporting earnings. We could also look at a straddle. How did a straddle perform if we started 2 weeks before earnings? Did the options climb? Did they decay? How did the call do 2 weeks before to the right up to the day before earnings, right? How did those different strategies perform? Now, of course, to do that by hand is very difficult. You'd have to go to each symbol, look up the options chain, look up what the options were in a particular day, then what they were on another day, and write that down, then go back another earnings and another earnings, and imagine doing that for each stock. It would be impossible, right? We would need something to help us out to do that type of analysis. And in addition to that, you've got all these different stocks, right? It's not just, yes, you have Microsoft, you have Apple, you have all these different stocks. How do I put them all together and see them all in one place, right? So that's what this tool is doing for us. So you could see here, it has over 3 million different, back-tested strategies or strategies in earnings from a historical perspective. It performs for us, overnight. It takes any new earnings, any new events, performs it, adds it to that historical database to produce these statistics for us. So now that we have this screener in front of us, let's take a look at the analytics and columns that it's presenting to us before we could screen it out and see what type of insights we get, right? So starting from left to right, you could see that it tells us the stock symbol. So this is sorted alphabetically, but we could change it if we hit on any of these columns, it'll resort. So the next column is market cap. So you can see when I click on it, all the columns resorted from high to low based on the data in there. So now Apple shows up first. Okay, Apple, because it has the highest market cap in this particular screener. So now we got the symbol, market cap. The next thing, now we go into the details. This tells us on this row, what is the particular strategy that was analyzed and the correlated statistics for it. So here we identify the strategy type where it says it's a credit put spread, right? A credit put spread is you sell a put on one strike and buy a put on a lower strike, which is a kind of a bullish spread, right? It's a bullish spread because you want the stock to finish above both strikes, the highest strike, for it to go out worthless. So that identifies the strategy. But a credit put spread could also be different strikes, right? You could have an in the money spread, you could have an out of the money spread, you could have strikes that are at the money. So we got to define that too. What type of credit put spread are we referencing? Well, the problem is if we go back in history and we look at different observations, the strikes are different, right? The strikes on, fourth quarter earnings where the stock is different than third quarter earnings and second quarter, because the stock is moving around. You have different options that you have to reference with different strikes. So what credit put spread are we talking about here? We need to some way, normalize or standardize the back test so we could compare similar credit put spreads, right? So this is telling us here that the credit put spread in this back test is selling the 50 delta put. Okay, so that's what the S50P means, selling the 50 delta put, which means an at the money put, and L for long. One is short, one is long. L is long the 25 delta put. So what this will do is say historically this is the strategy. If you looked at a credit put spread that involved selling at the money put, buying a 25 delta put, that was your credit put spread. So now we know the strategy. Next, we'll say, okay, well, if we're looking at the strategy around earnings, what reference points are we using, right? Are we using, the day before to the day after, the 2 days before, 3 days after? What reference points are we using to track that performance? That's important too, right? So that's what these next two columns are. They're saying historically, this is what we're tracking. So in this particular row, we're saying we're tracking it the day before it announces earnings to all the way to 1 week after the earnings announcement. So that's what this particular one is tracking, that date range. And you could see all the date ranges are different, that you could use filters, but let's stick with this one. And now what we did was first we defined the symbol, the market cap, and then the strategy that we're analyzing. So that's what we did so far. Now let's look at the results. What are the results here? You know, how did this strategy perform? And you know, if it was done one day before, kept the week after in Apple. So here are the results. So I'm reading from left to right. So here, number one, it tells us how many data points are in our observation, which is important. Are we looking at, you know, 10 years of data, one year, 3 years? What are we looking at here? Because that's important. We need to know what we're analyzing. And this tells us in this particular study, it's 12 observations. Okay, keep in mind earnings are only 4 times a year, 4 quarters. So you're still looking at 3 years of data because we don't have more data than that in a year, right? And if you click on that 12 observations, it gives you more details. But I'm just going to show you really quickly. See, when I click on it, it'll give us details each quarter, what was it before and after. But I'm going to come back to this, just letting you know, by clicking on it, you're going to get a more detailed analysis where you could keep drilling down. I'm going to close this so we could look at the top level. The next column, what it's telling us is the win rate. Basically, how often in those 12 observations did this strategy, if held, you know, held from one day before to 1 week after, how often from the start date to the end date did it result in a profit? So in the credit put spread, if you sold it, and then at the end of that period, if it was worth less, it would be profitable, right? Because you want it to be, when you sell something, you want it to be worth less so you could buy back cheaper. That here is telling us that it happens 75% of the time in those historical observations. Okay, and keep in mind, this is history. It doesn't mean that's going to happen exactly like that going forward. We're just looking at a historical view of what happened. Okay, but that tended to happen more often than not. 75% of the time, that resulted in a profit. But even in those 75% of the time, that doesn't mean that obviously sometimes it didn't, right? At 25% of the time, it didn't result in a profit. So the question is, on average, out of all those 12 observations, if I took the wins and then I took the losses, if we looked at all of it, what was the end payout or result? Because it could still be unprofitable. Even at a 75% win rate, if you're 25% of the time, your losses way exceeded any of the gains, right? Like for example, if I made a, you know, out of 10 times, if I made a penny profit 8 times, and then 2 times, I lost $1 each time, then it was an unprofitable, even with more wins than losses, it was still unprofitable. So that's what we need to look at. What was the average return of all of them? If I took all of them, my gains and losses, on average, what are we looking at here? And this is saying, on average, it was an 18% return. So overall, it was profitable out of those 12 observations. You did sometimes more, sometimes less, sometimes you had losses, but overall, if done all 12 times historically, it resulted in an 18% average return. Okay. So another thing we could look at is that's the average. And but the average also could get skewed, right? When we look at averages, a bigger number, right? Like skews a lower number, skews it. So the averages themselves could get skewed. If you have, an average return of a penny, a penny, a penny, and then you got one $100, well, the average will get skewed up. So what we could do is then say, well, if we split the returns, if we took all 12 returns and split them, 50% of them above a certain amount, 50% below, what's the median return? What is that middle return? And this is telling us 48%. Okay, so half of the returns were above 48%, the half of them were below. So that's so now we have a sense of, yeah, there's a lot of good returns there in this strategy. What about the best versus worst, right? How bad did some of these get, and what is the best out of all of them? So in this scenario, the best return was 62%. Okay, so whatever you had at risk at the time, right, based on what the return was at the end, the best return was 62%. The worst was 100%, meaning whatever you had at risk, that's how much you lost. Okay, so keep in mind with a credit put spread, the amount you have at risk is what what you would lose in the worst case scenario. So if you did let's say you have a $5 put spread and you sold it for $1. Well, the amount you have at risk is $4, because if at the end of at the end of the day, if you have to buy that put spread back for $5, your worst case scenario, it's worth $5. Well, if you have to buy back at $5 and you only received $1 when you sold it, that means $4 left your bank, right? You had to pay up for that was what your risk was. You had to pay an extra $4 to buy back out of your savings or whatever. So that's the amount at risk. And then we could take a look at if we're comparing these strategies, right? Because that's going through the the performance of the strategy. But we have this big screener. And if we're comparing these strategies, not just average returns and frequency of wins and best and worst, but sometimes we want to see the variability of these returns. Like, what's the standard deviation around these returns? Because even if you have a high return, if the standard deviation is really large around it, it means it's like the returns are all over the place. It's very risky, right? Like, so imagine if you had a strategy where, if it's always 10%, 10%, 10%, 10%, 10%, well, there's no standard deviation. It's always the same, right? That means that the average is 10%, but there's no variability because each time you have 10%, so there's zero standard deviations. So that means there's not a lot of risk in that. But if you're at 10% and you're like, sometimes it's zero, sometimes it's 20%, sometimes it's negative 50, positive 60. If you got all these variabilities around that average, it makes it very risky. It's not very reliable. You got your wins could be huge, your losses could be huge. So what is the standard deviation around those returns? So that's what this number is, right? The 56, 60. So you could see in this row, we're listing the standard deviations. And now we have a sense of, how risky these strategies are, and of course, options are going to be more risky than stock, just because they're derivatives, right? They're derivatives. They're lower price. They have a lot of the variability there. So we're looking at the standard deviation of those returns. And sometimes they're higher, sometimes they're lower, but in the screener, now we could just scan with our eyes, right? And see lower ones, higher ones, and what the strategies are. So we do have, so that besides the variability, right, the standard deviation, how much return do we get for each unit of standard deviation? Because maybe if it is even more risky, if the returns are so high, it might even be, it might still be good from a statistical perspective to do the risk one, right? If the returns are so high, given the variability and risk. So that's where this Sharpe ratio comes in. It says, okay, well, why don't you give me the ratio of the average return over that standard deviation, right? Now we can normalize and look at it. So that's what this is. This is the same 0.32, right? So now what we're doing is saying how much return for each unit of risk. That's what kind of like what that does, is normalize it. And it makes it much easier than to compare from one strategy to the next, or even if we wanted to compare the same strategy across different stocks. Well, how does this strategy look like in Apple versus Microsoft versus Google? What if we just wanted to compare those? And we could do that in this screener. Okay. So those are the statistics here. And then just for convenience, if there is a particular strategy that you're looking at that's of interest to you, that you want to analyze, and then you're looking at this strategy and you're saying, well, if it starts the day before, 1 week after, 2 weeks before, 1 day after, for convenience, on the same screener, we tell you, okay, based on this strategy in this time frame, here are the next days that would be for opening and closing. Okay, so here in Apple, for example, it says this particular strategy, if you analyze it, you would start analyzing in January 29th, and it would be held till February 6th. So it's a little bit still early, right? Because earnings are January 30th, but it tells you how many days away. So it's very easy here to say, I'm looking at a particular strategy. I want to be alerted when it's coming up. You could do that by saving the strategy and bringing it up, and then on that date you could start analyzing, seeing if it fits your criteria.
Hey, Dave, we did have a question. I know there's only about 5 minutes left, coming in from Santa, and he's asking, should we look at high Sharpe ratios and low standard deviations when doing our analysis?
Yeah, so one thing is we're looking at historical data. That's number one. So you have to keep in mind that, well, that's all we could analyze, right? We don't know what will happen in Apple. There's no way of knowing. But we're looking at the historical.
Boy, that would be great.
Yeah, because if we did, you wouldn't even need all these. So we're looking at the historical data to first analyze this. And that's our starting point. And then when we're looking at it, yes, when we're at the Sharpe ratio, what it does is helps us evaluate the returns versus the risk. Okay, because you're always balancing that. Do I have a positive expected return, right? And if I do, how much risk am I taking for that expected return?
Yeah, actually, Cincy gives a little thing that Cincy said he uses this screener literally every day, loves it.
Oh,
And he says, I look at max loss and avoids those with high percentages is one of the rules he has. So that's
okay.
something he looks at. But
Okay,
that's,
awesome. Well, thank
yeah,
you. Thank you for that, yeah, feedback. And um, so we're right up at the end, Will, but what we could do is maybe tomorrow we could, or wait a minute, I'm sorry, Monday, right? Monday we're gonna revisit it and use the filters to start screening out some scenarios and then show how to save your filters so you can just come back and look at it whenever you're interested, right? And you
perfect.
don't have to once you have it set up where these are the filters that fit all my criteria, you could save it and then you don't have to remember it or write it down. It'll just you come back, you could pull it up and it'll be there.
Yeah, great job, D. We did have a bunch of new users pop in today, or new viewers pop in today. So everyone remember to subscribe, thumbs, like the channel. We have a bevy of old videos you can watch on our YouTube channel. Well worth watching. You can also email us, support@MarketChameleon.com if you have any questions or if there's a screen you'd like us to look at in the morning. Anyways, great job, D, as always. Everyone have a great trading day and a great weekend. Thanks, buddy.
Thanks, everyone. Have a great weekend.